Hey everyone, it's Ed Kime, CEO over at Quantcha, and welcome to our June 14th news and updates video. We've been working on some cool stuff over the past few weeks, and a couple of things that we launched are some new global screeners. The first one we launched is for protective puts, which are also known as married puts. And these are great screeners so you can look globally at the market and find stocks that you can own that you're also capping your downside for a put premium. On the other side of the coin, we've got protective calls, which are also known as married calls, and this is where you short a stock, but then you cap your downside for a premium of buying a call. Now let's dig into these a little bit more in depth. So let's take the protective put. This is an example of a long stock position. Now this stock is trading at about $46 a share right now, and you'll notice at the left side of the chart, the downside, if we were to go down to about $42 a share, would be a 7% loss on the stock, and the upside is about an 8% gain if we hit that 50-ish mark. Now, let's put that aside for a second and think about a long put at 44. So the put struck at 44 means that it's basically worthless at anything above 44, but as soon as you go down below 44, you're gaining a dollar a share for every dollar the stock goes down. So if you combine these two positions, what you end up is in a situation where you own, let's say, 100 shares of stock and you own a protective put for the downside. And that means that now we've sort of shifted our profit to the right a little bit. So you have to go move up a little bit further from that $66 a share point. I'm sorry, that $46 a share point, because you have to account for the premium of the put that you bought. But the nice thing about this is the downside protection, because as you can see, as soon as you hit that $44 a share point on the way down, anything you do that goes below that 44 cancels out between the stock and the put. So your downside is capped at $44 a share, meaning that you will never lose more than about 6% on this position if you're in it. Of course, the risk you are taking here is that you have to go further up in order to account for the gain, but it's a nice protective way to do it. And part of the advantage of the protective puts that we have in our screener is that it enables you to look at the market at large, or especially to drill into a specific stock using a variety of expirations in order to find something that zeroes in on the sort of risk you're looking for. So we'll take a very quick tour of that. Here we are at the Quantcha website. This is just the home page. You can come up here and click on screeners. It'll bring you down to take a look at that. We've got our covered calls, and protective puts. Click through the protective puts and it'll bring you right to the screener. You can also get to it via the breadcrumb drop down here. We're on the protective put screener, but you can see you can get to the covered call screener or the protective call screener or others. Now I'm going to take a look and say that I want to go long in Microsoft. So I'm going to enter Microsoft as my symbol here. And in addition to that, I'm going to come down and make a couple other little changes. I'm going to say for moneyness, I want to be at about at the money, meaning that I want to get a put that's very close to where the stock is right now in order to protect my investment. And the rest of the stuff, I guess we'll just say we want any open interest. The rest of this looks fine. And so now what we've got is a handful of trade ideas. This is for the 6 months starting in September. So you can see this is the idea here is that we would hold this for a long time. We'd own this really from September to March, depending on the actual trade we went in for. And so let's just take a look at this first idea here. And you can see the annualized range, but for the sake of what we're looking at for the protective put, you want to drill into the actual trade itself, because these annualized ranges are based on when a trade expires if you were to reopen that trade with the full amount that you had in your for the original investment at the time. So here we've got an example for one trade where we're buying 100 shares of this stock at near $46 a share, and we're buying a put at 46 in order to get us this downside protection, and it's costing us $3.40 a share. Now we are after hours right now, so the spreads are a little wide, and given the nature of what we're doing for investing, like that's a fairly hefty premium to pay in order to protect your downside. But this 5.5% minimum is it's basically entirely because of the fact that you're paying for the put itself. Because you'll notice that if the stock were to stay flat at 45.97, you'd actually get 3 cents a share from this put, because the put is technically already in the money by a little bit. But when you're in market hours, you'll see the numbers change a little bit more. Now, if we take a look at the full analysis of the trade, you'll see kind of what we expected from before, where we've got that upside from the long stock, and then the put protecting your downside. The great thing is the break even here tells you that we're looking at a 48.75, which means you do have to have a little bit of upside potential. But the nice thing is the minimum return really as far down as you go. As soon as you hit 46, anything below that, you are protected. And the profit density is kind of what you'd think. I mean, you'll notice that this is here, but the reality is all this is representing the same loss. So there's really not much risk. Like I said, once you hit that nice 46 point, you are protected on the downside. So that is the protective call in a nutshell. Now let's take a look at the other side of the coin, which is the protective call. And this is a little bit more sophisticated, at least conceptually, because a lot of people are afraid of shorting stock. And there's good reason for that. Obviously, there's always the risk of the stock taking off, which is why the protective call is such a great tool. So if we look at this short stock position, this is the same stock we were looking at before, at this point trading at about $46 a share. If the stock goes down, you'll notice for the implied range we're looking at here, we were looking at a 15% upside if the stock were to go down. And if it went up that 1 standard deviation, it's about a 16% down movement. If we take the call at 47, now this would be to hedge that trade we were looking at. This is just a long call by itself. We obviously don't make any money until we break even beyond the price of the strike, beyond the price of the call over the strike. So strike's at 47, looks like to be about $1 per share. So about $48 we start making a profit. Now, of course, if you combine these into the protective call view, now what we're looking at is the protective call at 47, where this is the money and this is the protection. So really, at this point, as long as the stock goes below 45, you're going to be profitable. But the good news is anything at 47 or above, and you've maximized your loss. Now, a couple things to point out here. We talked about that maximized loss, but another thing that's kind of key here is on this left side, you'll notice these numbers are really big. This negative 100% and this 118%. The reason those numbers are as big as they are is because when you go into, for example, a protective put scenario where you're buying the stock and you're buying the put, you have to pay all that up front. Now, if you were to go into a short stock scenario, in this case, the stock's trading about 46, so you'd have to produce another 50% above this in order to cover your margin. So it would be the $46 you got for credit for shorting it, plus $23 in addition that you'd have to provide for margin. But because we've got this protective call here, we know that it's capped at 47, so the margin requirement you have is the difference between where the stock is currently trading plus the strike price you've got, or rather the strike price minus in this case, minus the current price of the stock, because we're dealing with this potential loss you'd have to make up for. So if the stock went up to 47, your call wouldn't do anything, but you'd have to pay that dollar a share difference. But if it goes above that, you are capped because of the call. So really, at this point, the margin requirement you have is the dollar in difference here plus the money you're paying to open that call position. And so as a result, we're able to get a lot more leverage because let's say it's $1 a share for the call plus $1 between the strike and the current price. So it's $2 a share. You could go much further than if you had to produce $23 a share in order to short it here. So that's just a good example of how that works. And so if we dive out and we take a look at the protective call screener, there's a lot of ways to drill into this. Again, we're going to pick a specific stock. Let's go take a look at, let's just say for the sake of argument here, we wanted to go back to Microsoft again, and we'll look for some, let's say at the money, and we'll look at any of them. When we apply the changes, let's see what comes up here. And here we have really the flip side of what we saw on the protective put side. And let's take a look at, kind of this January time frame. So you'd be able to short the stock for the next 7 months because it's June right now. So look at about 7 months of shorting, and you would have your risk would be capped here because of the fact that you're looking at, for your shorting this nearly $46,000 worth of stock, but your risk is $300 because you're paying out all this money in order to get in the position in the first place. And if we click through, we can take a look at the P&L there. As before, as we looked at, the stock's at 46, you are capped above that. And then you've got the full implied range just so you can see that really the break even is that 43.66, and then which is here, and then your maximum loss, your minimum return is 46 and above. So that's a whirlwind tour of the protective call. And so thank you very much for tuning in this week. If you got any questions for us, please hit us up at hello@quantcha.com or leave a comment down in the comment section. Thank you.